SEBI and NISM are officially on the hunt for India's sharpest minds in the National Financial Literacy Quiz 2026. Whether you are a UG or PG student, this is your arena. Phase 1 is the college round. Crush the college round and you move to the regional round. And finally, we'll fly to the grand finale at the NISM campus. The college round is live right now. Scan the code.
So this was about the National Financial Literacy Quiz, a joint initiative of NISM and SEBI. For more info, you can visit our website nflq.nism.ac.in. Hello and good evening, everyone. I am Mansi Ghanekar, working in the Investor Education Department of NISM. NISM is a capacity building initiative of SEBI. We at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we work in 5 broad areas: long and short-term academic programs, certifications for market intermediaries, e-learning programs, training programs for working professionals and academia, and various investor education initiatives. Today's webinar topic is DIY Mutual Fund Investors Checklist, Process Before Products. So for this, we have with us Lisa Pallavi Barbora, a seasoned financial coach and personal finance expert with over 20 years of experience in wealth and asset management, as well as financial writing for leading publications like Mint and Business Daily. A certified financial coach practitioner trained with Wise Monkey Financial Coaching in UK, she empowers individuals to simplify financial concepts, overcome money-related stress, and align their finances with their life goals. Through one-on-one sessions, group coaching, and workshops, she helps people build clarity, confidence, and purpose in their financial journey. Now, I would request Lisa ma'am to begin with the session.
Hello, everyone. Thank you so much, Mansi, for the lovely introduction. And although obviously I'm not able to see the participants, it's really quite a big pleasure for me to be here and be able to deliver this session for all the participants that have joined in. I'm quickly just going to share screen so that you all can see the presentation. Just give me a moment, please. Okay. All right. So I hope everyone can see the screen.
Yes, ma'am, the screen is visible.
Yeah. Okay. Great. So so as Mansi said, this is a presentation around do-it-yourself investing, especially for mutual funds, and why we are going to talk about process. Now, before I even start anything, I want to also remind Mansi that there was a poll question I had asked to be played beforehand. Maybe they, you can play that while, So do you use mutual funds, firstly, to begin with, to invest? So that will be nice to understand. But why are we talking about process in the first place? So investing is one thing, but think about yourself if you say fall sick, right? When you fall sick and for a few days you're still feeling sick, you're not getting better, what do? You just open your medicine cabinet and take the medicine that you think is going to be right for you? Or will you go to the doctor? And when you go to the doctor, because I presume if you're not getting well for a while, you will go to the doctor. If you go to the doctor, what does the doctor do? Do they just take out their prescription pad and write the medicine? What the doctor does is first asks you about how you're feeling right now. When did the illness start? And, what are the symptoms, etc. Then they will ask you, what kind of, is it an illness that reoccurred? Is it an illness that, okay, sorry, the poll results have come, so I'm a bit distracted, but only a small portion, about 40% have said only a small portion invest. A large portion, again, 38%, not at all, 15%. I am considering 7%. Okay, so we know that around 38% of the participants here invest in mutual funds in a big way. That's good. The rest of you, hopefully, after this session, you will feel more confident to go ahead and take that step as well. Now, coming back to why we need process. So the doctor checks in firstly about how you're feeling now, then checks in whether this condition is something that's reoccurring, then checks in what is your lifestyle, what are your food habits, etc., allergies. And then after all of this information, the doctor will diagnose and then prescribe medicines. So think about investing in the same way, right? We begin with products, unfortunately, especially in the do it yourself space. The first step is, okay, where do I invest? But the process dictates that we need to do a whole lot of other stuff before we get to the products. And the process is important because only then the products are going to be right for what you need them. If you take the wrong medicine, your illness will not get better. You will not get better. Similarly, if you don't invest in the right products for your financial objectives, you will not achieve them. It's that simple. Okay, next slide. Okay, this was just my introduction, but Mansi's already done that. Okay, so what will we learn today, right? Let's be very clear from the beginning of this session. What are you going to take away from it? Why is process permanent? What does this mean? It means that no matter what life stage you're in, no matter how long you've been investing, like how many years, you may be starting now, or as we saw, 38% have already been investing in MFs in a big way. You always need to go back to the process, okay? Your checklist before you begin, as I said, for most people, it is about returns. However, we are going to learn that it's about a lot more. Common mistakes to avoid, of course, through the experience of the years, through the experience of others, we have arrived at a set of common mistakes which people tend to make, especially when they are doing it themselves. And that's why it's important to address this. And of course, in the end, how to have that MF portfolio customized for you, because your financial objectives, investment goals, etc., are not going to be the same as your colleagues, as your neighbors, as your friends. Okay, so that's what we will learn today. This is I mean, if you think about it, this topic can be as technical as you can potentially make it, right? However, what I'm going to address today is a simple process that anyone can follow. So don't get intimidated. And at any stage, if you feel that you want to ask a question, write it down and we'll address everything towards the end of the session. No question is good, bad, or silly. Just whatever doubts you have, please write it down as we are going through the session. Okay, so again, process versus products. What you see here is a typical, what we call an asset allocation quilt. You may have seen a few of these in media. This is something published by Mint in the last few months. I don't know the exact date, but it has data till the end of 2025. Okay. And this is a typical asset allocation quilt. Now, as I said to you, why is process important? Because we all have a different way of approaching our investments. We all are individuals with different financial objectives, and hence the process is something that we need to kind of have in place so that whatever we do with our money is useful for us. But if you see it from the other side, from the lens of the product, there are several product manufacturers. When I say product manufacturers, I mean mutual funds. There are many of them, I think 51 different AMCs at last count, and with hundreds of products and several categories of products. What these quilts show, and you can see any quilt, it can have international assets, different categories, physical assets, only different categories of equity, whatever, you will find that no one type of investment comes up on top is the top performer every single year. And if that is the case, and you are only looking at returns and choosing the product as step number one, then every year you'll end up choosing a different product from a different category, maybe a different asset. And how is that going to work out? Because it'll just be a whole lot of products, and you are investing looking really in the rear view, because it is what happened last year. Because no single asset, no single category, no single fund will be the top performer every year. So that is the reason also that we need a process. How do we filter through all of this to arrive at the funds that work for us if we are not looking at return? It's not that we are not looking at return, but we are going to look at it in the right manner. The second reason for process is this. We all have goals, we all have desires, we all want to do something in life with our money, with our time. Somebody is waiting to buy a house in Mumbai, in Bandra, maybe the lovely suburb. Somebody is waiting to buy a house in Goa. And somebody else wants to immigrate and go to another different country and buy a house. Maybe somebody wants to start a venture in 5 years. Maybe somebody wants to save and invest for their children's education, maybe for their retirement. It could be a whole lot of things. But if you think that the same investment is going to cater to all of these, it's not correct. The same portfolio cannot work for all these goals for several reasons. And that is the second reason why we need a process to begin with and products only at the end. Okay. Now the checklist that I spoke about. I did say that we are going to have a checklist for you. So here is the checklist. Why am I investing? This seems simple enough, and you may have heard this spoken many times. Remember, goals. Why am I investing directly kind of translates to what are my investment goals. However, that's not all it is. It is goals are not just, okay, I want to do this or I want to do that. And I will elaborate that a little bit in the next slide. But you really have to think about what is it that you want to achieve. It could be that you are in your early 20s and you have started investing, and what you want to achieve is wealth creation because you don't have any other financial responsibilities, and that's fine. It could be that you're in your early 30s and you're yet to marry, and you want to kind of have a stable pool of money. That's also fine. But remember, unless you know what you're trying to achieve, it will go back to that product collection and really no structure to your investments. It's always a good idea to write down your goals. Research shows that when we write this down, it kind of imprints in our mind, and you have a 75% higher probability of achieving that goal. And even financial goals work the same way. The second thing is, what is your time horizon? For a 25-year-old, the investment portfolio, the investment journey is going to look very different than for a 45-year-old. That's one timeline, time horizon. The other thing is what you want to do with your money, right? If you are investing to, say, afford a down payment for a house you want to buy, it's going to have a very different timeline than if you're investing for your retirement. Hence, it's going to have a very different portfolio approach for both these goals. They are both financial goals, but both will require very different products. What asset class am I already invested in? Now, we all will have something. And what I have found, in fact, a lot of the people that I coach, whether in workshops or individually, they have a lot of money sitting in bank accounts. Not just one bank account, several bank accounts. And a lot of that surplus for investments actually comes out of that. Other than that, there could be deposits, there could be money sitting in, say, gold or some little property or something. But whatever you have already, you need to first take stock of that because that is your current situation. What you also need to kind of include in that is what debt you have on your side. So by debt, I mean any loans you've taken. Could be housing loan, could be personal loan, could be credit card overdraft. These days, it's not so uncommon to find that along with the regular investments, people also have high levels of debt. When you take whatever assets you already have and take out the debt from that, it gives you your net worth. And your net worth actually defines your financial position today. So before you start building your investments and adding more through mutual funds, you need to know what is your financial position today, because you have to then add products that is complementary to that, or it is helping that, etc., based on your goals, right? So this is also very important. Do I have the ability to absorb volatility? Now, one of the things, why do we invest, right? So as everyone can have different goals, but one common goal that everyone is likely to have is investing for a secure future. Call it retirement or call it whatever, but you do invest so that your tomorrow is going to be secure, right? Because we are saving today and we are building wealth for our tomorrow. Now, one common aspect to that is inflation, because whatever your value of your tomorrow is, it will be impacted by inflation, which is going to take away from that value. And to fight inflation, to be able to overcome the ill effects of inflation, we invest in assets like equity, which are market linked. And when we do that, when we invest in market linked investments, what also happens is that you face volatility. Now, I did tell you that a lot of people I find have lots of money sitting in bank accounts. Now, if there is enough inflation in the economy, the value of that money is only going to shrink over the years. Hence, it's important to invest in a way that you're beating inflation, because your bank account is giving you 2.5%, 3% interest in a year, whereas annual inflation we know is going to be 5, 6%, regardless of what the published CPI is saying. There is also things like medical inflation. We are paying at least 8 to 10% more every year on any kind of medical consultation, even forget medicines and treatments. And education is going up at a crazy 8, 10, 12% rate, depending on where one is studying. So all of that put together, our inflation rate is quite high. We do know, and entertainment, of course, you understand how much more you're paying for just going out and seeing a movie or having dinner somewhere. So all of that adds up. And that's why you can't leave money in the bank. But when you shift money to market linked investments, volatility will show up. Now, it's all fine to say that, yes, I can. I will get 12% return, so I will invest here. But when volatility actually shows up, which it has in the last 5, 6 weeks, you see what is happening. One day the market is down 2%, one day the market is up 2%. If you have started investing in the last 2 years, you are probably seeing red in your entire portfolio return. That is volatility. Now, how much of it can you absorb? The answer to that is not a simple percentage, or that I can absorb half of it or 60% or 40%. It will have to do with your life stage. It will have to do with your job circumstances. It will have to do with your current assets. And we will learn a little bit more about this in the presentation. So step one, as I said in the previous slide, is why am I investing? So your goals. This is very important. It sounds very boring to think about money and goals, etc. I get that. Don't think about them as goals. Just think about them as your desires, or your financial responsibility or financial objectives. What this slide is telling you essentially is that you have to distinguish between short-term goals and long-term goals, and you have to define them. How you define them, we'll see later. But why do you have to define them? Well, you have to define them simply because the requirements of each type of goal is different. A short-term goal is like, say, you want to have, you want to travel the world next year. So it's 1 year time horizon, or you want to pay a down payment on a car or a house in the next 6 months. So it's high priority because it's coming up like almost now. You need safety and stability with whatever investment you're using because, again, the time is very short. So you can't take that kind of risk. And usually, short term goals, because they're so visible, they're so close by, they are not flexible in the amount. You have earmarked an amount, and by and large, you're going to require that amount. So you can't be very, you have to be very precise with what you need to invest to achieve that amount. Long term goals are slightly different, and hence the approach has to be different. Firstly, they tend to have a larger monetary impact. Education goals, retirement goals, the amounts we are talking about are huge. Retirement goals are in crores. Now, education goals are also in crores. But they are larger amounts than your very goals, which are very near term. Also, the impact is longer lasting. What I mean by that, say your retirement goal, you will need that money for 20 years. So if you go wrong, if you fall short, you will suffer for a longer time. You will not be able to recalibrate so quickly then. Even education goals, I have heard people selling their own homes to fund their child's higher education. So when that happens, it's just that the structure process planning was not there and it's too late. So the monetary impact is larger, it's longer lasting. You have to beat inflation, which is what we spoke about. But the thing is that with long-term goals, they're more flexible because it's so far away, it's so blurry. You have a vague kind of number in mind, but you can keep recalibrating that number as you evolve in life, as you move forward in life. You may start earning more, so your contributions will change. Certain assets would have given returns already. You may achieve certain goals before you are hitting the timelines, etc. So there is more flexibility with this. But don't take it lightly. I'm giving you this heavy stuff in the beginning because it's important stuff. You can skip all this and go to the next steps. But the step around goals, to my mind, if you get it right, the other steps, the result or the consequences of it will be definitely a lot more impactful. So, specific goals, what does that mean now? Goals can be anything, right? So a lot of people nowadays don't want to, a lot of young people in their 20s don't want to necessarily get into a 9 to 5 job. They want to have their own venture, they want to be their own boss, they want to have their own profession. And that's great. But is that a goal? Not really. The goal can't be, I want to start my own venture. You have to be more specific. For example, I work in financial literacy. My goal can't be, I want to spread more financial literacy. I have to define it. How is my venture going to spread financial literacy? Is it going to be a fintech venture? Is it going to be a physical financial literacy academy? What is it going to be? Because both ventures require very different kinds of input in terms of funding. So you have to define your precise goal. It has to be measurable. How do you know that you have been successful in your financial literacy goal? How do I know I've been successful? Is 100 people good enough for me to be successful? Is 1,000 people? It has to be your measure, but you have to be able to measure it, not just in terms of how will you know you have achieved your goal, but also how much funding goes into it. So it has to be measurable on both fronts. It has to be attainable. Now, I could desire, for example, to go out and I could have a measure saying that I want to, do education for 5,000 people in 1 month. Is that attainable? It's difficult if I'm just starting out. So you can put your goals, but if they're going to be unattainable, the basic unattainable goal that I come across often is buying property. People want to buy expensive property, but they want to do it in 1 year's time when they don't have savings. It's not attainable. So give yourself the room to actually achieve your goals. Is it relevant? Now, It's possible that your parents, for example, are from a professional background. They're all lawyers. You studied law, but you are very good at adventure sports and not so good at law. So you become a lawyer tomorrow, but the work you do is not relevant to your life's values. You'd rather be outdoors. But being a lawyer means you have no time to do the things that are meaningful to you. So find a way to make your goals relevant to your life and your daily requirements. A goal, for example, to own a luxury car may be one that is only a status goal because your neighbor also has one, but has no relevance for you because perhaps you already have an office car or you use the train to go to work. So your car just is parked in the garage anyway or in your parking slot and has no real use beyond that. So why spend so much money on it? And of course, make it time bound. Don't make it endless because we know that when we give ourselves deadlines, we are that much better at achieving them. Okay, time horizon in the whole goal setting strategy, time horizon is really, really important because the same assets cannot address goals in two different time horizons. So equity assets, understand, are not for short-term goals. What are short-term goals? Anything between 0 to 3 years. So if you're planning your destination wedding 2 years hence and you want to use equity assets only, it's going to be risky. I'm not saying it's not possible, it's going to be high risk. What that means is the chances that you will not achieve it are also high. Fixed return assets are not good for long-term goals. Why? Because post-tax, they rarely beat inflation. In the long run, inflation eats the value of your money. 100 rupees 10 years later at a 6% inflation is worth only 55 rupees. So if you want the value of your money to grow in the long run, you have no choice but to invest in inflation beating assets. So that's your long-term goals. Typically for short-term goals, which are 0 to 3 years, we use low-risk fixed return assets. And for medium-term goals, which are 3 to 7 years, we use a blend of both equity and fixed return. And for long-term goals, which are 7, 10 years plus, we use high growth equity assets. So this is your basic framework. The more you stick to this, the more you will understand that it's a structure that works. Everything does not have to be in high return, high risk. Okay. Step 2. Asset allocation. So what is asset allocation? We spoke about different assets. See, after you've mapped your goals, right? And you know, okay, I have 3 goals which are coming up in 2 years. I have 5 goals which are coming up in, 10 years. You know what kind of time horizon is there. Then you start picking assets based on those goals. But there is another merit to asset allocation. You could be 25 today. And as I said, your only goal could be wealth creation. So should you invest everything in equity? The other goal for asset allocation is that you are just diversifying across different assets because you don't know what tomorrow holds. And any asset can do poorly in a period of, 0 to 2 years. So you're protecting your entire portfolio return. Your portfolio return is a combination of what different investments are doing in your basket. Now, this data, I'm just going to go through it in a bit. But first thing I want to tell you is that asset allocation, and there has been so much research done on this, and you can look it up anywhere. It's a given that asset allocation is what drives 80 to 90% of your returns. It's not the products you choose. So if you're 100% invested in equity, the returns you got in 2025, for example, will be much lower than somebody who is spread across different assets. This is again from an asset allocation quilt. And if someone wants to see the picture, I've got it. But let me just, which ET Wealth had published recently. So in 2025, an equal weighted portfolio, and these are all domestic portfolios, an equal weighted portfolio which had 33% in equity, 34% in equity, 33% in debt, and 33% in gold did the best and gave a 28.4% return. Now, that is because of what gold did in 2025. It went up 70%. Could you have predicted it in January 2025? Yes, everyone expected gold to do well, but this well? No, right? A portfolio which was equity heavy, which is 60% in equity, 30% in debt, and 10% in gold, delivered 13%. Now, when we talk about overall portfolio return, this is not bad at all to have an annualized return. But this return was achievable only thanks to the 10% in gold. So even a 10% in a different asset can help you achieve your portfolio return. If you were only invested in equity in 2025, your return would have been closer to 4 to 5%, I think, something like that. So asset allocation matters, but in the long run, nobody keeps 30-35% in gold. Why not? Well, because gold is not an earning asset. It helps in diversification, but gold does not have any income of its own. So we don't, want to take that long-term risk with gold. However, as you can see, even 10-20% in gold works. But typically, people don't have that much in gold. They do have about 10-11% in gold, and it's not required either. What we do find over longer periods of time is to achieve an 11 to 13% kind of annualized return, equity allocation needs to be between 50 to 70%. So if you want an inflation beating return, let's forget the numbers. If you want an inflation beating return, you need to have 50, 60, 70% in equity. You don't need to have 100%. What is the rest for? Your short-term goals, for your emergencies, for your long-term cushioning of your portfolio returns, which we are seeing happens. If you want to keep your portfolio returns consistent over a long period of time, this asset allocation is important. Okay, so now if you want to customize this is step 2, remember, step 1, we said define your goals. Step 2 is define your asset allocation. So how do you customize your asset allocation? I spoke earlier about the fact that, how much volatility you can absorb depends on what your life stage is as well. So that's also true. When you're younger, you are better able to take more risk simply because you may not have as many financial responsibilities as somebody in their 40s or 50s. And when you're able to do that, you think that, okay, you know what, this is my time to take that risk, to learn from it. If I'm lucky, I'll make money. If not, then I have time to go back to the boring stuff. There are a lot of young kind of investors, especially who have some access to capital through their parents, who don't want to go into simple things like mutual funds and SIPs. They want to do startup investing. Because the logic is that by the time they are 30, they would have learned and they would have moved on. But it doesn't mean that you need to put 100% of your money into it. Yes, life stage matters, but the tried and tested is tried and tested for a reason, right? So long-term investing is not about taking big risks. It's about doing the same thing consistently, committedly, year after year. So that's one thing. Life stage will determine your asset allocation. Your debt repayment will determine your asset allocation. Now, unless you have some surplus cash every month, you won't be able to invest. Truth is that lifestyle inflation has caught up with us. For a lot of young earners, that's really weighing heavy, and credit card overdrafts are a reality. Personal loans are increasing at a great rate. Payday loans are tempting. And when that happens, you take away your ability. If you're going to get into debt early in life, you will take away your ability to create wealth for yourself when it really matters. There are people who are in the equities market, for example. There are people, professionals who are managing money and investing for clients, but they are not able to invest their own money in equities because they have a huge housing loan. Now that housing loan has shifted to people having several personal loans or credit card overdrafts, but EMIs kind of take away the freedom to invest. So be very careful about how much you have, because if you have heavy EMIs, first work on repaying those, investing for emergencies, and then move on to taking risks through things like equity. If you don't have an emergency fund, or just money saved up, really, what is an emergency fund? It's money saved up for a rainy day, at least 9 to 12 months worth of expenses. If you're not, I mean, if you don't have that requirement, just have a good chunky bit, say 6 months of money saved up somewhere, because who knows tomorrow what will happen. Jobs are uncertain now, expenses are uncertain. Look at what is happening around the world. You should have one pile of money which is only for emergencies. Unless you have that, don't start taking risk with equity, because when something like what has happened in the last 6 weeks happens, it wipes away 2 years of returns. If you don't even have an emergency fund, you lose your job, your equity investments are in red, you have nowhere to hide. So give yourself that cushion so that if things go against what you thought, you have something to fall back on. Insurance for those who have financial dependents, term life policy, and of course, health insurance for everybody is mandatory before you start taking risk with your money and investing in equity. If you have a secure job, say you've been working in the same organization for 10 years and you've carved your space there, it's an industry which requires your kind of specialization which not many people have, then you know what, you perhaps are in a better position to take higher equity kind of risk. If you're in IT services and your job is not secure at all, then go slow on that equity risk. Don't pile it up, because job security is not there. You are adding risk on your investment side. It's not going to work well if things go wrong. And of course, your goals. So your asset allocation will depend on all these things. And because each one of us is in a different life stage and these things show up for us differently, we will end up with a different asset allocation. Step 3. Now, before I get into this, can I request the second poll question to be played, please?
Yes, ma'am, doing. Done.
How do you choose which fund to invest in? Can all of you please quickly put a response to that? We've spoken about asset allocation. We haven't really gotten to fund selection yet, which is what we are going to do now. And I'll have to go through that pretty quickly. But if you can put in a quick answer, then that will really help. Based on past returns, maybe the fund manager appeals to you, where others invest, or a trending fund that has come up, that also happens. So what is the primary reason to invest in a fund? Do we have some answers yet? Okay, so based on past returns, fund manager. So the bulk is past returns and fund manager. Okay, great. So that's about half the audience has responded. That's fine. Right. Okay, sorry, one moment. Okay, so fund selection. Now, most of you, almost 60% who answered, invest based on past returns. But that's the worst thing to do, because as we saw in those asset quilts, every year, every calendar year, your top performer will change. So you're looking at the 1 year return and you're investing, but next year there'll be somebody else on top there. So you'll buy that fund. First thing is that you see the age of the fund. At least funds which are at least 5 years in existence, they have shown a track record of returns through different market ups and downs. Those are good choices. So you can filter through that, okay, funds which are at least there for 5 years in existence. Size of the fund. The second thing is size. Now, it doesn't mean that larger sized funds will do better than smaller sized funds. No, but you need a filter, right? Because as I said, there are, okay, at this stage, actually, I wanted to put in, okay, I'll put it in after this slide. But basically, there are several categories of equity funds that SEBI has notified. And within each category, there are several hundred funds. So, how do you filter? Now, size gives you a sense that, okay, there are several other investors already in this fund for more than 5 years at least, because that is our first criteria. And if that is the case, then the fund must be doing something right. So we are just trying to create a filter for ourselves. We are not saying that the 5-year-old fund will be a better performer. This is just a filter that we'll get fewer funds now to choose from. The second, then you go to the expense ratio. The fund expense ratio is also published either in the fund fact sheet or any kind of public domain where you'll find this. And when you see the expense ratio, you'll realize that it should be within the average fund expense category of that uh, type of fund. Okay, nothing which is outlying. So, for example, low cost funds like ETFs and index funds should have low expense ratio less than 1% or 0.5% a year. uh, Actively managed equity funds probably have the highest expense ratio. In international funds, there could be double expenses because you're paying expense of the fund that you're investing in here. And if they are investing in an underlying fund, then the expenses of that as well. So these are some things you have to be careful about. Next, you make sure that the quality of the fund is good. In debt funds, you have to pick only the AAA rated portfolios. Again, all of this is published in fund fact sheets. In equity funds, it's harder to check quality because you obviously don't know individual stocks and you're not expected to. You have to rely more on the existence. And the next thing, what we are talking about, is the returns. Returns, when we see, we don't see just the past 1 year, past 3 years, or past 5 years return. To check whether this fund stands out on the basis of returns, you have to check the consistency via rolling returns. Now, rolling returns give you, whether you're looking at a 3-year return or a 5-year return or whatever period of return, they will give you what that return is on a daily basis. So, say I'm sitting in April 2026 and I want to see the 3-year return of a fund that I'm interested in. Instead of seeing the return on 6th April 2026, I'm going to see the 3-year return on every single day from 6th April 2025 to 6th April 2026. That's rolling return, and that will give me 365 days of data of the 3-year return. Now, with that data, I can try and see, okay, when the market goes down, how does this fund perform? When the market goes up, how does this fund perform? What is it compared to the benchmark? What is it compared to its peer set? It gives us a lot more data and shows us how consistently the fund is actually performing. There is no luck when you see rolling returns, which can show up in the point to point returns. And it will give us a sense of what the fund does in different market environments as well. Then check the investment style, which is going to be mentioned in the fund fact sheet for sure. Now, at this stage, I wanted to put in something. Why am I not seeing the chat box? Sorry. Why am I not seeing the chat box? I wanted to put in. Okay, I'll put it in at the end of the presentation. I would like to share with you the page for SEBI's categorization of mutual fund schemes. Do your homework. You want to be a do-it-yourself investor, you need to do some homework. So see the categories, different categories of funds available. Remember, based on the asset allocation exercise, narrow down those categories to 2 or 3 that you want to own, and then do this fund selection process. SIP or lump sum. So I get asked this question all the time. Should I do an SIP or should I invest in a mutual fund? Now, SIP is not different from a mutual fund. SIP is a facility to invest in a mutual fund. Yes, the question can be, should I invest in a SIP, which is a systematic investment plan, or should I invest through a lump sum, a chunky amount? The reasons for investing in SIP versus lump sums are different. SIP helps you invest regularly every month a defined amount in the fund of your choice on a date of your choice. A lump sum is when you're just taking a chunky amount of money and putting it, you can do it anytime. Usually, it's better to do when you are getting that lump sum income and or there is a market fall or crash and you are confident that this is the time to add more money. SIPs are good for salaried people who get regular cash flow every month and they are able to invest regularly every month as well. The thing to note is SIP and lump sum can be done in the same fund, in the same folio, doesn't matter. You're just investing more. If you are doing SIPs, predefine the SIP amount and date for each month. Define an annual step up. Don't leave it at what you have done today. You may start a 10,000 rupee SIP. Next year, if you are expecting a 10% increment, increase your SIP automatically by 10% as well. So that is how you will create exponential wealth. And have a plan for your annual bonus. So that is your additional lump sum. You can again invest it in the same fund in the same folio. So that's what you need to know. Common mistakes to avoid. As I said, chasing return and top performers, that's one common mistake to avoid. Over diversification. What we do when we go for returns in the step one is we end up with too many products over a period of time. That's over diversification. It adds to risk, perhaps, but not to your return. Avoid thematic and sector funds because they require you to have much sharper strategies of entry and exit, and they can have a lot higher risk than regular diversified funds. Don't ignore asset allocation. I've said enough about that. Don't stop SIPs in falling markets. Why? Because when markets are falling, when value is falling, your SIP is already a defined amount of 10,000. When value falls, you get more number of units. We know equity is a long-term 7-year plus game. So why not accumulate more units? It also helps in smoothing out the short-term volatility and making your return more consistent. Don't buy NFOs, not blindly, but just don't get into it. As I said, if you are investing, you're starting out, you're considering, look for funds which have at least a 5-year return experience. They're already there. They're already doing the job. So why do you want to get into something that's just starting out? Uh, don't invest only for taxation, but be tax aware. Equity fund returns are taxed very differently than fixed income fund returns and even than international fund returns. So you have to be aware of this. There is a lot of talk of global investing. Don't just blindly buy a fund just because that is what should be done, but you should know what the post-tax return is going to be as well. Now, here is your fund portfolio framework. After you have done your goals, you have done your asset allocation, and you have done the basic filter of funds, you will still have 4 to 5 funds in every category that you want to invest in, and you have to choose between them. But what are the types of funds that are going to be basic in helping you create wealth? Remember, we spoke about having your emergency money in place. So, for that, you need to have a liquid fund at least, which is absolutely low risk. This is not for tax purposes. This is not for anything. This is just for that stability and safety of capital. A short-term debt fund for your short-term goals. Remember that 0 to 3 year kind of goals, you need a short-term debt fund. A balance advantage fund or a multi-asset fund, which is the hybrid variety of funds for short to medium-term goals. And just one fund in each of these categories can help you. A large cap equity index fund, which is the most low cost, simple way of investing in equity, is what you can start with for your long term goals. Start with that fund definitely. A diversified exposure through flexi cap fund is the next thing that you can add. And then perhaps a mid cap fund, which is for slightly enhanced returns as compared to your large cap equity index fund. But remember, for mid cap funds, your time horizon should not be just 7 years, but you need to stretch it to at least 12 to 15 years. And then, of course, think about a gold fund to add to your portfolio for diversification. These are 8 categories. If you pick one fund in each, that's enough. That's 8 different funds. You don't really need more than that. The small cap and international funds should come in once you have 5-6 years of experience in equity, not at the very beginning, is what my experience is. So there is another poll question. Should we play it now? How many funds do people have? Okay, in the interest of time, I'm just going to continue. Why is this slide here? We have already gone through what is your basic, fund framework you need to have. See, a lot of discussion these days is around alternate investing, global investing, cryptos, startups, etc., etc. That is good to add that return kick to your portfolio. But a 12% return, if you can achieve that, goes a long way. What is really important is the quality should be good and that you should be able to remain invested. Remember that question about how much volatility can you absorb? If you build your portfolio in a way that you are able to achieve 12% return for a long period of time, that's good enough. This slide is showing you 10,000 rupees invested for 10 years at an assumed annualized return. Annualized return doesn't mean every year you'll get 12%, it'll go up and down, but overall it becomes an aggregate of 12% a year. In 10 years, you make some return, right? But increase it by another 10 years. Your return doesn't double, it increases exponentially. See, 22 lakhs becomes 92 lakhs. Add another 10 years, it becomes three times, more than three times, at 3.1 crore. In the next 5 years, that 3 crores becomes 5.5 crores. And 44% of the return, bulk of the return, comes in the last 5 years. So, really remaining invested out of this 9.8 crores that you can potentially make with a 10,000 rupee SIP for 40 years at 12%, 44% of that return comes in the last 5 years. So, what is important is not chasing high return today and hoping you become a millionaire in 5 years, but investing regularly and remaining invested. Mutual funds are a great way because somebody else is doing the work of investing for you. If you follow the process and you do it in the right way, you will get to this as well. So, the do it yourself process works for whoever it is in whatever life stage, because you are defining your goals and your timelines, you're allocating then the assets, then you get into the products, the fund selection, you review what is there, and you repeat the process. In 5-10 years, you're in a different life stage, but the process remains the same. If you are able to stick to a process you can follow, you won't have an unmanageable, excessive, bloated portfolio. You will have something that works. Then, with whatever is surplus, you can take your tactical calls, do the risk that you want to. So that's it from my end. Thank you very much. I'm going to stop this here. And I am just going to, I would like to put in that, yeah. This is the SEBI circular for the categorization where everyone can go and check what different kinds of fund categories are available. And on the basis of that, once you've done your asset allocation work, you can decide which are those fund categories that work for you. And remember the framework I gave you for those 8 simple funds to begin with. Sahil, Mansi, if there are any questions, we still have some time. I can take it up.
Yes, I request attendees to ask their question in Q&A so that ma'am can address those questions. Ma'am, there are a few questions in
Yeah,
Q&A
so I
section.
can see somebody is asking where can we see these categories. In the chat, I have put SEBI's link, which will give you the categories. Now, if you want to look at rolling returns, etc., which I spoke about, so rolling returns are something that are very important, okay? And there are certain public websites like there is Value Research, Morningstar, or Advisor Coach, which have these rolling returns, and you can compare it across peer sets and across a different, what do you say, against the benchmark. So please check these websites. Chart not received in. Okay, it's not a chart. It's a link. Okay, I'm putting it here. This is the link for 1 second. Fund categories as per SEBI. Please go and check this out. This will help you. How much folio in one person minimum? So folio doesn't matter if you have, as I said, those one fund in those 8 categories, you have set up your basic portfolio you need to build your cushion, to have your wealth creation, etc. Can't see. I've put the link here now, I think. Maybe Sahil, you can share it. I mean,
Yes, ma'am. I did share.
what are the advantages of investing in MFs compared to stocks? So that was one of the poll questions. We ran out of time a little bit, but here is the advantage. The foremost advantage of investing in MF compared to stocks is that you don't have to, if you are not in the financial services industry and it's not your job to look at stocks and what is it investing in stocks. I'm talking investing, not trading. We are not looking at charts and trying to kind of predict what the price of a stock will be tomorrow and in a week or whatever. We're talking about investing. Investing requires you to know a company, requires you to know the standing of a company in an industry, in a sector. How is that company going to do? What are the competitive advantages that company has? What benefit does the management bring to table? If your day job is something else, you're not going to be able to spend so much time on it. Even if you can, you'll probably cover 5 companies, 10 companies at the most. A mutual fund house or an asset manager is covering hundreds of companies because they have a team to do it and they have a qualified manager who's doing it. As I said, there are many new mutual funds, which is not to say that they are not doing a good job. They are. But if you are starting out and you don't understand which direction to go with the funds that are already established for at least 5 years. They have a performance track record. The foremost advantage is that there is a qualified manager whose job it is to pick these stocks, doing it day in and day out with the help of a team, with the help of their own process. We are talking about an investing process. Mutual funds have their own investing process and they try to stick as much as possible. The good ones try to stick as much as possible to that process. Okay, so access to that process, access to that fund manager, low cost. At around 2% annualized, you get access to a portfolio of stocks. If you don't want to pay that 2%, you can invest in an index at less than 0.5% a year. So low cost is the second advantage. Ease. It's easy to open an account and start transacting, and you can invest small amounts. You can begin with 500 rupees, 1000 rupees, and build it up over time. There is transparency, there is flexibility through SIPs, STPs, SWPs. So there are a whole lot of other advantages as well. How to customize your portfolio. As I said, this will take some time, but as I said, you have to follow that asset allocation process, which I spoke about. And then for that customization, start writing down, okay, what age are you? What are your fixed financial responsibilities? How much risk can you take? What are your EMIs? What are your financial goals? That will help you customize your portfolio, not the products that are available in the market. If I have 50 lakhs and I want regular income, how to invest to get income after 1 year? Uh, See, if you want stable income, you need to invest in debt funds. Okay, debt funds have the ability to give you anywhere between, say, 7 to 8% return annualized. So it depends on how much income you need. But if you need stable income, debt funds are a good place to start. You can invest in that, leave it for at least, I would say, couple of years, then start a systematic withdrawal plan. If the fund is delivering, say, 7 8%, maybe your withdrawal should be slightly lower than that on a annual basis. Exit loads. Does our capital see, for some funds will have exit loads. In equity, usually the exit loads will not exceed a year or so, which is fine because equity is not a 1 year investment anyway, as we spoke about. It is going to be, it should ideally be more than 7 years. In liquid funds, debt funds, there will be exit loads, but those are not for retail investors. Those are really for large institutional investors, and those exit loads don't really cross, say, 7 days. So it's not relevant to us. That's a very small percentage as well. Compared to SIP, alternate investments give more returns. So why invest in SIP? I don't know what alternate investments you are talking about. If you can mention, we'll say. But again, as I said, if you want to chase return, then you have to be ready to absorb the risk as well. So, for example, alternate investments like cryptos gave a very good return till last year when they crashed. It's almost half of what the value was last year. So, are you okay to absorb that? That what purpose is it serving for you? Did you withdraw when you had the highest return in that alternate investment, or did you wait and then you didn't have? So it's not that alternate investments don't serve a purpose, but first get your basic portfolio right. Mutual funds cater to all different types of assets. You can invest in low risk, you can invest in gold, you can invest in equities. It doesn't have to be equity. Build your basic portfolio with all these assets. Multi asset funds are now investing in REITs, real estate, or InvITs as well. So you have access to different assets. You can build your portfolio as you desire. Once you build your structured portfolio that is going to cater to your future and your fixed financial goals, after that, think about alternate investing, really would be my suggestion. Should we invest in physical gold or gold funds? I would prefer gold funds because, again, it's ease of transaction. You can invest small amounts. The cost is low. You can exit anytime you want. You get the price advantage, but you don't have storage issues. You don't have to check quality, etc. It's an easy entry exit whenever you need. So there's liquidity, there's flexibility, there's transparency. It doesn't matter whether it's physical or gold fund, you allocate the same amount. But as I said, it's very rare to find somebody investing 30-35% in gold. Also, gold doesn't have income of its own. Investing in a stock or stocks through mutual funds means you're investing in a business. They have an earning to showcase. Gold doesn't have anything. So if it can go up fast, it can crash also. So it's prudent to maintain, 10-15%, not more than that. Even then, I do see mostly people maintaining 8 to 10% in gold is what anecdotally we have seen. Profit booking should be done once you're nearing your goal. Remember, we said equity is a 7 to 10 year goal. Now, let's say your goal was 7 years away for equity, right? 5 years have passed and it's just 2 years away. We know that equity markets in 2 years can be very, very volatile. So, at that stage, if you have 100 rupees invested in equity and you need 50 of those for the goal that's coming in the next 2 years, take out 50, you book your profit worth of 50 rupees and keep it in a stable, low risk fund, like a debt fund. Leave the rest 50 invested in equity till your next goal. So that's how we do the profit booking. It's not really done based on markets. What is a contra fund? Contra fund is a very specific fund which invests in stocks that are not conforming to the general sort of economic growth model. It could be a company that's coming out of huge debt. Some other company may have bailed it out, or they may have got fresh funding into it. It could be a company that's transitioning or adding on a new segment, and hence the earnings are going to increase, hence the price is going to change. So they have all these kind of different contra means, different opportunities in that fund. So the portfolio should ideally in a contra fund look very differentiated from a regular, say, flexi cap fund. But remember, contra funds come with high risk as well, because what if that differentiation doesn't work out and does not translate to price gains or profits? How should the AMC be selected? There are too many, and how should one common investor? As I said, the first filter is the size of the fund, the age of the fund. It should be at least 5 years plus, and then the size. Again, for me, the size was not so much about how it's going to perform, but the fact that there are going to be a lot more investors in that fund, and if it has been in existence for more than 5 years, then you know that the fund is doing something right, that the investors have trust in it. So it is an easy way to filter. The AMC will come through that. If the AMC has been in existence for that long, delivering good returns, then you should be fine with it. But pick up fund fact sheets, go through fund fact sheets. You will find in the top 10 to 15 asset managers. All this is there in. If you're going to do it yourself, you should know about the AMFI website, which is the Association of Mutual Funds of India. It has all the industry information. when you look at the top 10 to 15 asset managers, they do cover a whole lot of different categories, and everything is available within those 10 to 15 asset managers. So you can go with, whoever, through your filter. As I said, even in your last filter, when you come out, you'll still have in each category at least a handful of funds to choose from. The final choice will have to be yours, but you'll have to dig into the rolling returns, to size, to consistency, etc. ETFs are good, but for ETFs, you do need a broking account. You can't invest through the statement of account route, or through a simple demat holding. You need to have a broking account. And there are some pricing issues around ETFs, plus you can't do SIPs in ETFs. So yes, ETFs are a good way to invest, definitely the lowest cost way, but their counterparts, which are index funds, is what you can do your SIPs in as well. Debt funds, yes, debt funds don't beat. So this is the thing, right? When you are investing for short-term goals, beating inflation is not your goal. Your goal is safety and stability of capital so that you can achieve that short-term goal. So we are not looking at beating inflation with debt funds. We are creating an emergency corpus. We are catering to our short to medium-term goals. And as I said, for 5 to 7 year goals, you have to use hybrid like multi-asset funds or balance advantage funds, right? Which have a mix of debt and equity. Debt is a cushion. And for your real short-term goal, 0 to 3 years, you don't have an option, because if you're going to look to beat inflation, you will end up with volatility. Other than CAGR, I showed the checklist. It was rolling returns, age, size, expense ratios. Yes, additional purchase in our existing equity fund. If your equity fund is good quality, you've done your research, definitely you can go on investing, provided your investment goal is 7 to 10 years away. Don't withdraw from your SIPs, don't stop them, invest incrementally if your investment goal is 7 to 10 years away and you have good quality equity mutual funds which you have already invested in. Can we invest in equity hybrid for SWP? Yes, you can invest in anything for SWP. It's just a facility. Capital appreciation is a function of the amount of time you remain invested. But also remember, when you do SWPs, you will be paying tax on every withdrawal. So even for that debt fund question, you can structure a withdrawal, but you will be paying tax. So be mindful of that. For long-term horizon, what percentage of my portfolio should be in high growth equity versus? So what we have found is that if you want to achieve like an 11 to 13% return, at least 50 to 70% of your portfolio should be in equity assets. Not high risk. We are talking about not really small caps, micro caps kind of equity, but diversified equity funds, some mid caps. You can have 50 to 70% of your portfolio for a 11 to 13% return. And as I showed on my return slide, 12% return is actually good enough to create a huge corpus, provided you give it time. Okay, how can we convince young minds to invest in mutual funds than others? You have to show them the benefits. I don't know how to convince, but convince them to start investing a little bit. Everything doesn't have to be in one thing or the other. We can always apportion it. Can we withdraw money from NPS? This is not an NPS PFRDA presentation. Can you please share the Mint 10-year asset return here? The presentation is with NISM. If they can share it, I think they'll be sharing it on their website. You can see it again. It's there. Plus, you will get it. Mint is publicly available on their website, so you can get it there. Do not get into NFOs. How to choose NFOs? Do not get into NFOs, because what the NFO is proposing is probably already there in the existing funds. Go for the existing funds unless the NFO is proposing something which is radically different from what is already available in the market. SWP is a systematic withdrawal plan which helps you withdraw amounts. Just like an SIP, you are investing a defined amount. You can define the amount you want to withdraw. Say you have a fund which has a 10 lakh value today. You can choose to withdraw just 20,000 every month from it, the dividend plan is something which the fund decides how much to give out to you and on what periodicity. So SWP is really in your control, whereas the dividend option of a fund is not. So I think I've gone through all the questions and I hope I've answered most of the queries. I really enjoyed talking to all the participants about this subject. And I think if as I said, the presentation will be put up by NISM, so you can refer to it for that process, which is the most important thing.
Yes, ma'am. I think you have answered all of the questions which were asked in the Q&A. Also, I can see there are few attendees who are thanking you for the session. Means Sandeep and anonymous attendee and more there are. Yes, ma'am. I think on that note, we can conclude the session. So yes, thank you so much, ma'am, again for sharing your time and knowledge with us. It was really great having you here for the webinar. And also thank you to all the attendees who joined today's webinar. Yes, thank you. Thank you all.
Thanks a lot for having me.
Yes, thank you. Thank you so much, ma'am, again. Thank you.